Welcome to this explainer. Listen, if you're a founder right now, you absolutely know the hustle of trying to lock down that early stage capital. It is tough out there. But today, we're going to completely remap your strategy for finding startup funding. We're looking closely at some recent liquidity data that completely updates the map of where angel money actually comes from.
Let's dive right in with a pretty striking reality from our sources. Your next angel investor? Yeah, they already got rich. For years, founders assumed that to find real wealth, they had to pack their bags and head straight for California. But the truth is actually so much better. The person writing your next check is much, much closer to home.
Because here's the crucial point we need to wrap our heads around. Angel money doesn't just, fall from the sky. It gets made. Someone builds a company, they sell it, and suddenly people who used to collect a standard payroll check are holding some serious cash. A liquidity event is essentially a treasure map. It shows you exactly where your next investors are about to appear.
So that brings us to the literal million-dollar question. Where exactly is all this new money hiding? Well, if you're still hunting for cash in California, you are missing a massive tectonic shift that happened in 2025 right under your nose. The map of where angel investors are minted has fundamentally changed, and you need to update your coordinates fast.
Think about what we call the old trap. For years, founders would just burn through months of precious runway flying to San Francisco, trying to get just one mildly warm intro on Sand Hill Road. But let's compare that to the untapped new reality of 2025. The wealth map lit up brilliantly on the European continent. The new angels it produced are actually way closer to Bratislava than they are to Palo Alto.
To really grasp the massive scale of this shift, we need to look at a watershed moment that happened on your side of the ocean. I'm talking about Klarna's September 2025 public listing. This wasn't just a win for one specific company. It was a literal factory for creating your future investors.
Let's break down the numbers. Klarna floated on the New York Stock Exchange and pulled in roughly $1.37 billion. That massive influx pushed the Swedish company's market cap to a staggering $15 billion. That is an enormous amount of wealth suddenly crystallized in the hands of European operators.
And the immediate human impact of that? Completely staggering. On day one, shares surged from a $40 listing price all the way to a $52 open. That single surge carried more than 40 current and former staffers straight into the Millionaires Club overnight. And keep in mind, that sits right on top of the 115 or so operators who had already crossed into seven-figure territory back in 2021. You suddenly have dozens of people who woke up incredibly wealthy, actively looking for their next bet.
Now, strictly impartially speaking, looking at the full timeline like our sources do, we have to acknowledge what happened next. The stock didn't hold. By spring 2026, it fell nearly 79% from its September peak. The party ended fast. But, and this is absolutely vital for you as a founder, the liquidity in that early selling window was entirely real. The people who sold during the debut still walked away liquid. So whether the stock held over the long term isn't really the question you should be asking. Who got paid in that window is the real question, because money that gets made gets reinvested. Those are the people who fund you next.
But you know what's really interesting here? Europe isn't just suddenly waking up to this game. While everyone was obsessing over the PayPal mafia in the US, Europe has actually been running its own wealth creation machine for 20 years without getting nearly the credit it deserves.
Consider the timeline of what they call the Skype mafia over in Estonia. It is incredible. It starts back in 2005 when eBay bought Skype for $2.6 billion, and then Microsoft bought it again in 2011. This created a core group of early operators who took their massive payouts, stayed local, and mentored the next generation. They literally put a country of 1.3 million people on the global tech map and kept it there.
This brilliantly illustrates how the cycle actually works. Exits produce angels, and angels fund the next startups. Take Tavid Henriques, Skype's very first employee. He went on to co-found Wise, and then wrote early angel checks into the next generation of giants, including Bolt, which has since raised close to $2 billion. And it doesn't stop there. According to the data, there are now more than 300 former employees from unicorns like Allegro, EPAM, Verif, and Pipedrive out there writing checks. This loop is already running, and it is running right in your backyard.
But hold on a second. Before you start frantically cold emailing every single name you can find, you've got to understand a key distinction. European liquidity looks fundamentally different than American liquidity. If you just copy-paste an American playbook onto a European map, you're going to fail.
When you look at the 2025 data, a distinct pattern jumps right out at you.
Out of about 860 total European startup exits, a massive 27% were private equity buyouts, while IPOs stayed pretty muted. That drastically changes who actually ends up with a checkbook in their hands at the end of the day.
And here is exactly why that distinction matters so much for your strategy. A typical blockbuster US IPO is loud. It means hundreds of employee millionaires in a single morning, creating this massive, noisy wave of capital. But the European reality of a private equity buyout, it's much quieter. It tends to make only the founders and the very early team liquid, which really concentrates the wealth.
Just look at some of the major European buyouts recently. You've got Vista taking a majority stake in Nextthink at roughly a $3 billion valuation. Workday buying Stockholm's Sanalabs for €1 billion. Vector Capital acquiring Showpad out of Belgium. These are massive, real liquidity events. But because they are buyouts, they concentrate wealth into a much smaller, tighter circle of newly liquid operators, giving you a quieter target list with far less noise to cut through.
So what does this all mean for you? What is your ultimate advantage over a founder chasing that exact same angel money in America? Well, it's simple. It's the proximity advantage.
As our sources perfectly put it, you are not competing for the attention of a SpaceX engineer in Palo Alto. Think about that engineer for a second. They receive 1,000 cold emails a quarter from desperate founders all over the globe, and they read absolutely none of them. The good news is, you don't have to fight through that packed inbox.
Instead, your distinct advantage is proximity. You are literally just 2 hours away from someone who sold a company in your exact sector last year. You share a time zone, you understand their local market context, and crucially, you can ensure they read your first email in their native language. That is an unparalleled superpower when it comes to fundraising.
Okay, let's translate all of this into an actual, actionable roadmap. It is time to execute this highly targeted approach right now. No more spraying and praying.
Here is your exact 3-step playbook. Step 1, pick a recent, local liquidity event in your specific sector. An IPO, a buyout, it doesn't matter as long as it's in your domain. Step 2, identify 5 key operators from that event whose backgrounds match what you are building. Step 3, write them a highly specific 3-paragraph email. Now, let's dissect the anatomy of that email, because, honestly, you cannot afford to mess this up. Paragraph 1, exactly what you built, no fluff. Paragraph 2, the hard, specific problem currently sitting inside your business. Paragraph 3, the one crucial question that only their specific recent exit experience can answer. You aren't just begging for cash, you're asking for targeted expertise from someone who literally just solved the puzzle you are working on.
I want to leave you with this one final provocative thought. The window of opportunity right after a liquidity event, when the newly minted cash and the appetite to invest perfectly line up, is incredibly narrow. But that window is open right now across Europe. The wealth is already there, the map is drawn. So my question to you is, who are you emailing before this explainer is even over? Go find your angel. Thanks so much for joining me on this explainer, and I'll catch you next time.